Let's start. I'm Neil Foster. I'm home team from Brown Rudnick. I'm the chair of the firm's technology sector practice, and may I add to all the other welcomes that you've had so far. Rather than introduce the panel, all of whom I know pretty well, I introduced Toby earlier today. And so I've already done that bit. But the other panelists will introduce themselves when I ask them a question rather than going along the line. It's just more efficient to do that as we're going through questions. I'll make a couple of opening remarks and then I'll kick off. But this panel is about equity finance and M&A, my areas, and in blockchain and crypto. And Toby's report, which you've all got but won't have had a chance to go through, it's incredibly readable, that report, and I encourage you to look at that. Data in this sort of area, Toby, goes off pretty quickly, and this data is really up to date. And again, huge thanks on that. I'm going to be asking Toby a few questions about that. But just to kick off, we were talking about last time Toby and I were talking at a conference. It was his conference, and it was the week after FTX. And the data that Toby would have been reporting on wouldn't have been quite so positive. The report that he's taken you through in his keynote was positive. But I've been chatting through last night, Toby, ganging up on you, and possibly the panelists might challenge you and us on the positivity of that, and we'll come on to some of those questions as well. So that's going to be one of the themes. We're going to have a panel that are actually going to disagree with each other. If possible, that would be fun. Other comments, unprecedented times. Well, I'll certainly challenge that. That's not something that Toby's been saying. It's actually a bit of a theme. You saw the last panel, Jess was talking about fraud is systemic. It's part of the human condition. Fraudsters fraud. To fraud people. And these types of assets are no different. But there are just different ways of doing that. And there are, this unprecedented time. Well, lawyers always talk about precedents. And so the precedent that Toby had touched upon was peer-to-peer finance. Well, a lot of that technology, of course, originated with peer-to-peer file sharing before that dot-coms. Well, dot-coms also went through, we had the crypto winter. Well, the dot-coms went through, I made my career at the beginning doing dot-com financings. We did IPOs, and they were overvalued, and some of them were vaporware. A couple of them were frauds. We did financings with no due diligence. We did dual listings on the day after the 3rd anniversary of incorporation. Those were the days. They were the fun days, and then they crashed. They crashed in second half of 2000. They crashed in 2001, and then they rebuilt. Did that mean that the internet was cancelled? Of course not. I mean, that's a daft thing to think. So why would the underlying technologies associated with this just disappear? Because of FTX and Luna and Celsius and Voyager and so on. And there was a lot going on last year, those shocks. But those shocks aren't unprecedented. There were more in 2000 and 2001. And then, of course, we had 2007, when the banking crisis started. People talk about 2008, but it was 2007 when Bear Stearns went. And so this isn't unprecedented times. But what comes out, and maybe we'll touch upon this as well, because we're talking about equity financing and M&A. Well, that's into businesses. It's not just trading. So into businesses, well, and this was touched upon in the remarks made by Toby as well, real businesses are built. From the dot-coms, a lot of those dot-coms don't exist, but you have, incidentally, you have something like second mover advantage for search. or was that 7th or 17th mover advantage for search and social media? Google wasn't the first search engine. Facebook wasn't the first social media platform. And so there will emerge. And what emerged from that was consolidation. And so, as an M&A lawyer, I've been predicting that consolidation will happen. But who are going to be the consolidators? Toby mentioned that one of the consolidators was FTX last year. The statistics you'll see in the report on M&A, incidentally, will also demonstrate that last year and the Q1 this year, there have been some mega financings, but Toby, there haven't been the mega M&As. So when will and who will do the consolidating, and when will that happen? Is it going to be what I've been predicting, which is that surely with this new asset class, there are going to be consolidation by traditional finance and traditional exchanges? Surely that will happen. Just as print media had to buy digital. Well, they bought them late. AOL was bought for 49 billion, which is probably 48 billion more than they would have done if Time Warner had bought them a year before, and maybe even 48 billion more than if they'd bought them the year later. So M&A is a question of timing, like a lot of things. And so when will that be? And there are some M&A professionals on the panel and investors and with their own experiences of all of this. And nobody does, two venture investors on the panel, nobody does investments for the purpose only of investments. It's to sell for a profit. And those exits, when are those exits going to be? Have you got exits in your portfolio? And we'll explore some of that too, because we very much want to, nobody is investing unless they can predict with some sensible visibility. Nobody is going to invest here unless they can persuade their investment committee that there's a chance of a return. And there are obstacles to that. There are frauds, there are insolvencies, there are regulatory uncertainties in the US, but we know from Toby's slides, and if you look in his report, the dominance of US investment. But is that going to continue? And that'll be an interesting thing to talk about. We haven't talked about, a few years ago we might have predicted maybe that Asia would have been the biggest of the investment jurisdictions, but actually the US has been. And after that, after the US, actually on all of the data, after the US, the UK has come second, which we might not have predicted in this sector. And it's actually by quite a step as well to the next jurisdiction as well. And that might not have been predicted. So regulatory uncertainty, these sorts of systemic shocks. And Toby, let's move into some of the questions here. We're talking about those sorts of things, but you said that Q1 this year and the end of last year, Q1 this year, if you extrapolated on an annualized basis, would be something similar to last year, but on a VC investment basis. But Toby, isn't that just in volume of deals? What has happened with values as well? And what do you predict for the rest of the year on venture?
Yeah, no. So I think there's a new normal, right? So firstly, equity rounds are longer-term investments compared to a token where the IRR can come very, very quickly. In the token market, you've seen a few exceptions like the Arbitrum airdrop, but it's pretty much dead for new issuance, right? This typically happens. It also happened in 2019 to 2020. I think you're just going to see. It's really interesting, right? Because the market, the crypto market itself, with the bull signal of Shanghai, with people getting interested in Bitcoin as the banking sector's in crisis and a wave of innovation, you've got a lot of bull signals there. But obviously, investors also have quite a lot of leverage now, right? Like there's DCG, Alameda was one of the most aggressive in terms of pricing and valuation, famously in the bull run, which served in the bull run, which and etc. However, everyone realized after the fact that it was a massive accounting trick, effective accounting trick. More favorable to the investor since the most favorable time for the venture investor with capital that
Could you, because I haven't introduced you, could you introduce yourself and your fund just now, but also some of the very positive statistics that we were chatting about could be viewed as glass half empty as well as glass half full.
Sure, happy to, and thanks everybody for attending. Xavier Segura here, one of the general partners at Morgan Creek. We're a multi-asset management fund, really just catching growth waves. And so kind of entering into the blockchain space, myself personally, I've been in it for about 7 years, and Morgan Creek in a similar capacity. And together we've done 70 deals, totaling more than $500 million into the space, all throughout the cap stack. So early growth and the macro environment and why were things so overcooked in the first place? Well, I think lockdown had a great deal to do with that. Certainly in the UX, there were very favorable tax incentives for redeployments of capital, and everybody was staying at home, which created a little bit more of a fat finger effect when you were trying to sort of have a way to channel this new time on your hands, and work days, sort of extended as a result of that. So when you think about is interesting, heating up in a dramatic fashion. And when we think about 2022, it's important to sort of characterize this as two different events. Whereas the first half was really the run-up in terms of the all-time highs that we saw in BTC, which sort of creates a cascade for the rest of the market, nearing 70,000. And of course, that creates more fervor and interest amongst the investment community. And then, of course, the second half, which we've probably talked a lot about this morning, which is sort of a little bit less catastrophic than that. So where are we now? When we think about Q1, kind of responding into Toby's report, which I think was beautifully done, and which is my job to understand, okay, how does this actually impact us and what we're seeing on a day-to-day basis? First and foremost, when we talk about a return, I think we're talking about a return more into like the Q3 aspect, shortly before the FTX side. And when we look at what's happening with the deal space, we said previously, we're in this game for the exits, although there's probably a nice conversation to have about the rise of the secondary opportunities. So I think that was sort of implicit within Toby's report, where, okay, you might not have the same banner type of investments in terms of the all-time highs, but that does create, a lot of favorability for folks on our space looking for secondaries, or furthermore, looking well as looking to extend their current round. So for example, they'll open back up an A round. That'll create a little bit more opportunity for existing investors to sort of catch their breath, and for new entrants to come in without necessarily automatically having the pressure to bring down a company in the write-down.
And we've heard a lot as well about the US. So Toby's report talks about the dominance of the US investment funds such as yours. 70 deals in the area is a heck of a lot of deals. And that didn't put you onto his top 10 list. But next report, Toby, hopefully. But in the US, you've also got a lot of regulatory shocks, bank failures, and so on. So what impact is that going to have in terms of in VC investments, US compared with Europe and Asia?
Absolutely, and I think it's important to sort of bifurcate that market, because certainly the US had led just in terms of some of the size of deals and the caliber. And then we ultimately look at a couple of different sectors, and I think Quynh is very active in this area as well, which is looking at finance and trading in markets. That's sort of one obvious area, because there's real benefit in terms of increased transaction speed, decreased latency, more visibility. And when those things sort of have problems is when you see the company sort of lose value. I mean, the biggest example is FTX with the massive obfuscation of what was actually going on. So if that's one area, that certainly has been somewhat hampered. And there was a lot of expectation on the futures market, which is kind of why you saw a little bit of a pop in the beginning of Q1. A lot of people were trying to have a little bit of a flip, predicting sort of the bottom on the BTC side, which hasn't really happened. And I know, Scott, we've been talking a little bit about, who's the backstop and who's kind of being able to sort of have this sort of margin call. And that's an important part to buoy our system, which is why you don't see that same sort of fluctuation when you're looking at S&P. But there's a high correlation between what's going on in the public and our private markets. So if that's one side, then you have the hardware side. And I was happy, Toby, that we were mentioned but not named in the chain reaction deal, which was one of the leaders in our quarter. Chain Reaction, guys, is just a Israeli-based company that is an expert in creating new chips for Bitcoin mining, and beyond that, it will be used to create a decentralized cloud and a highly encrypted cloud. So I think that's important to look at our space. Is it's going to move beyond trading, and it's going to go into real utility. And we're not going to necessarily be describing, X protocol, Y protocol, just like we don't talk about, SMTP as a way to, have a secure connection on the internet. We just say, I need a VPN or sort of an executable type of program. So with that, a lot of movement obviously now has gone in towards Asia, because there's a little bit more favorability on regulation. But of course, there's certain challenges within that market as well. So I think I'm very curious, and one of my high antennas went up here in this conference, because I have been looking for a lot of opportunities within the EU. We have some investments there with Improbable and my friends at Ledger in Paris. So I think that there's a lot of opportunity, not just within finance and trading, but also within hardware. And then, of course, metaverse. Hopefully that's not overcooked. I do think it's a way to just create more digital experiences. And we won't really be talking about metaverse in the same way. It'll just be another way to create a website or a way to transform a brand online.
Well, we'll come back to some of the elements of your thesis, your investment thesis, how you've pivoted, and how you're looking geographically as well. Quynh, Xavier mentioned challenges in Asia, so I wonder if you'd, GSR 10 years ago is like ancient history, and GSR is now a market maker for 10 years, the oldest in the world, and you're doing, so GSR doing market making, but you're doing M&A and also had the venture fund at GSR. Could you introduce yourself and tell us a little bit more about GSR? And also, we haven't yet challenged Toby enough on the positive elements or any other elements of his report. And because you're M&A and venture, it would be great for you to touch upon some of those.
Yeah, thanks a lot, everyone, for coming in. This is only a very different environment to the other conferences that I have been to, at least like Consensus or Token 2049, where people won't sit here and listen to the panel as much. So as I mentioned, I cover investment and M&A for GSR. GSR is one of the oldest and largest market maker in the world for crypto. We've been around since 2013, so this year is actually our 10-year anniversary. Think about it, we're actually before Mt. Gox actually happened, before Binance actually become big, before FTX, before all the Luna and every event actually happened. So being part of a company like this, we can see that the history of crypto and blockchain itself, it's evolved over time with a different large participant. What we're seeing at every single cycle is that there are new and bigger and more problematic things that are also being built in this space, and also more innovation actually built in this space every cycle. If you look at the top 10 tokens or the top 10 companies they value highly at every cycle, they change. But the one theme with it is trading, because liquidity in this space is important. So one of the examples that our CEO and a company like to say is that if you have an iPhone and your Apple share working well or not, or liquid or not, you don't really care. But in crypto, your token has to be liquid, because it's the way for the community, for the chain to validate, to stake, and actually for people to participate. Now, I'm not talking about thousands of tokens out there, but there's certainly a lot of the tokens in this space that actually really need that utilities in order to function, need liquidity to function. Because we talk a lot about equity, so I just mentioned that we are token maximalists in this space. So GSR have about 250 people globally. London, Singapore, New York are our main offices. We have 4 main business functions: market making for token issuer, OTC for spot and derivatives, asset management, which is a regulated vehicle in the UK for TradFi to get into this space, and the 4th one is investment, which I'm heading. When you think about investment, we have about 3 strategies. One is the early stage investment, which is pre-seed, seed round, where just like Xavier, we're looking for the next project, next company that is going to innovate this space, whether that in the trading infrastructure, NFT metaverse, or DeFi, or when it comes to things like Web3 ecosystem. How do we help the treasury, the CFO of this space, actually make their job better and well-function? The second strategy, which is strategic, because at the end of the day, GSR is a trading firm. We have pioneered trading infrastructure in this space for a long time, and we think that we can work with a lot of the CFI businesses to actually make this space more secure, safer, and also more transparent, and capital efficiency need to happen. Because at the end of the day, without those infrastructure, it's very difficult for the TradFi, the large institution that we've been talking about all the time, to come into the space. And the third is M&A, distress, JV, growth opportunity for GSR. So when I read Toby's report, and I know that Neil will talking about this as well, is that GSR is not mentioned as one of the top names in there. But when we read the other report from the blog and others, we are in the top names in there. I guess it's probably because of the information that being captured. We have made so far $100 million worth of investment and about 200 or so project and protocol. I think a lot of these are quite opaque. They are not actually being put out in a database like Crunchbase, but the blog has more of a connection in this space, and that's why they're kind of scraping this information. But I think when we look at that list, we also have to be careful. Do we want to be on that list, or do we want to be on the list that investors actually make the most money and helping company in this space? And so I'll rather be on that list in the future, Toby. So I think there's a few things that I want to talk about the investment and the M&A work. So first of all, in the investment space, yes, we can see the data is going up, and now we kind of coming back to, let's say, after Luna, pre-FTX level. But actually, there's a delay of deals in the space that are being announced. The data is being captured might potentially get information, some deals that are being negotiated since April, June, August last year, and it just takes a lot longer for investors to feel comfortable and come back to the table at either the same, different valuations, or at different rates, right? At least that's what we see from our side in terms of the data lagging. But that doesn't say that the market hasn't come back. In the past quarter or so, especially after every big event of this space, we see there's a pause. We're saying, hey, we're not going to bring deals to committee, because what are we proposing? We can't see, everything in a deal is we price forward. If you don't see the forward pricing and forward environment, what are we pricing against? The public comms are telling us something else, the private comms are telling us something else. So this lagging effect of the private investor and private entrepreneur coming to us and saying, hey, those guys are doing bad things, we are completely different. Within a week of FTX collapse, we probably have 20 different, DeFi exchanges come to us and saying, we are better, we're different, and we should be able to, to get investment and get community to be on board. But they forgot the fundamental problem is, first, do people feel comfortable to get into this space in the first place? Second is that the problem you're solving, the transparency, or is it actually the demand, right? The flow is something we always ask every company when it comes trying to build a trading infrastructure business. And so, so that effect of lacking, of valuations, of terms, of understanding the general flow of the market. However, we have seen in the past 3 weeks, or at least 3 months, that a lot of companies have came back and actually find a lead. They actually open to talk to investor about what is the value add that investor are going to work for them, rather than just take a check and leave, right? What are the terms, what are the protection, what are the rights that the investor are going to have? Because everyone come to you with a YC safe, what is a simple agreement for future purchase of equity or token. But it's simple. It's too simple that it doesn't work for the space. It doesn't say a lot of things about governance, about rights, about what if a lot of things that happen in this space. And so that is on the financing side. On the M&A side, we have probably seen that the 2 or 3 largest name in this space, which supposedly being the consolidator. We're talking about Genesis, we're talking about FTX, we're talking about potentially Binance as well, right? And they are potentially not going to be there. I mean, we know that FTX is not there at Genesis, but Binance, with the acquisition of Voyager, how hard is it for them to actually be able to acquire that business? I think it's very difficult without knowing much about the detail without the deal, but the US market potentially doesn't want them to be there. And so we are looking for the next consolidator to be on board. And I think the consolidator could come from 3 areas. It could come from the company, the C5 business in this space, wanted to expand the business or acquiring something like, I need to fix the lending market because everyone's saying they're lending responsibly, but they didn't do that. So who have the better risk management that can take on this? Because without leverage, the space doesn't work. So we need responsible leverage. So that's one. So within the C5 play in this space. Second is we're talking about the TradFi coming in. Maybe now is a reasonable time for investor from outside, for trading firm or for exchanges from other to come into the space saying, hey, I want to understand this asset class. I want to build things in this asset class, but I have 5 people in my company and we couldn't figure out what to do. So it's time to partner and do JV or work with them to actually acquire it. The third one is actually protocol themselves. I think there will be an opportunity for protocol and foundation to actually merge together, which we have seen with Polygon, have done a number of that acquisition, in order to go faster in building this blockchain infrastructure, rather than just relying on hiring more, getting more money to trying to innovate by themselves. The war in crypto is pretty open, and I think that M&A acquisitions with token, which I hope at some point are going to happen more and more often, will be an interesting topic to explore.
Yeah, well, certainly I've closed my first big financing with venture capital financing using tokens. You mentioned distress. I just want to touch upon that as well, because surely a profitable business like yours can then go into the market and acquire some good businesses. It's just that they're early and there's presumably a flight to quality in terms of the Morgan Creeks of the world, which Xavier can touch on in a second, as to, small companies with good technologies can be acquired because they haven't got revenues yet. And there might be a good reason they haven't got revenues, because they need to be regulated. And some of these are built to be regulated. They're waiting in the line for the FCA in the UK and US, possibly never, to get the regulatory license to. And also, surely there's an onshoreization, shouldn't be a word and probably isn't, de-offshoreization, that's even worse, ever since Bahamas and FTX and what have you. So that flight to quality, is that going to drive distressed deals by people like you?
Yeah, so distress deal could, as you mentioned, it could come from like an operating company and they couldn't, really function, or they want to be able to be part of a bigger business. But the amount of fundraising out there is still happening, right? You still be able to keep extending your runway so that you will not actually become a distressed company. But the other one that we think the more distressed, it actually could come from the large businesses. What we're seeing right now in the trend of distress is the genesis of the tide, well, I'm not mentioning it yet, but the Alameda, the FTX of the world have assets. They, within themselves, is so complex. They have acquired, they have built, they have invested, they have JV in so many different areas that when we talk to the bankers that doing these deals, it takes them months to actually organize a very angry group of creditors on one side and a very complex business on the other side with an overall understanding of crypto on top to untangle them and serve us with something that, hey, you can buy this as an ongoing concern business, or you can buy asset, or you can buy just the IP, right? So for us, what we're most interested about is probably on that, let's resolve this whole big mess of what's happening with these companies. Let's pick out the good asset and let's see, at GSR, we can price difficult asset. We can price things in crypto that others can't price, especially in the altcoin and derivative space. Let's use our expertise to see if we can buy the asset and make more like an ROE type return, or we can try to look for different licenses, asset within the space. And so that have been a good appetite from outside and our competitor to look into this particular area first.
Scott, moving on to you, would you introduce yourself as well? And also, a couple of the questions here, a couple of the points made by Quynh in particular. There are acquisitions of IP available here. There are acquisitions of small companies that do have a regulatory license but are light on customers. There are some with profits, revenues, customers, license, business model, everything built out. But there are a lot with only one element of that, and that's really valuable. So, and then you've also got clients. I know that you advise Morgan Creek, but you also, like me, advise some of the smaller companies that are pre-revenue, and then you get a shock to the market and struggle to raise that sort of money. So talk about some of the trends from the dozens and dozens of deals that you've done in the last 12 months.
Yeah, thank you, Neil, and it's a pleasure to be here. So I'm the leader in our U.S. tech group, a counterpart to Neil for our U.S. company practice. I've had the pleasure with working with Xavier at Morgan Creek for many years and some other significant investors in this ecosystem from the earliest stages at pre-seed all the way up through Series D and beyond. That's about half of what I do, is representing investors, helping them form funds, raise money from limited partners and deploy into deals. The other half, as Neil alluded to, is working with companies, operators, and entrepreneurs, forming new ventures from day zero up through those more significant capital raises and ultimately through liquidity. I think there's an interesting story behind a lot of the numbers that we're seeing here in the public data. Public data, by its very nature in this industry, is going to be partial, which is no criticism to Novum or PitchBook or any of the great sources of public data that we can get. Those are invaluable, and we need to collect as much of that as we can and rely on it because it's the best signal that we can get. But what's interesting is if you look behind those numbers from law firms like ours and others that do a lot of these deals. I mean, we did 125 technology deals last year. And so we get to see some of the private transactions that don't make their way into those public numbers. And there's a story behind even the 2023 numbers that we're seeing as quite down. Those are the deals that are being announced and that are being reported. There's a whole universe of deals. It's like a tip of the iceberg below it that's happening that are not announced. And they're not announced because they're down rounds. They're not announced because they are insider-only rounds or they're flat rounds. And none of that finds its way into that data. And we're actually seeing a tremendous amount of that exact activity. And to Quynh's point, paired with that, we're seeing a reassessment of investor perspectives on governance and controls and rights. Many deals that were struck 2-3 years ago are being done now as extension rounds or insider rounds only. But the deal is changing. It's not just more money at the same price or a later price. It's, yeah, we'll put more money in, but we're going to reassess governance and we're going to reassess investor controls and really reboot the entire deal. So those kind of things don't make their way into numbers. And also, to a point Xavier alluded to, we're seeing a tremendous amount of secondary activity. Right? A lot of folks on the investor side see huge opportunity in a reset in pricing for these companies and are being really opportunistic about opportunities they can take from founders, from employees that are seeing much more lengthy timelines through liquidity and are interested in liquidity and willing to take less than maybe the last round valuation to get that liquidity. And of course, investor to investor trades are happening too. So the activity is far more robust, I think, than the public data tends to indicate. And I think that's a really positive sign for what we're going to see as the headline price of Bitcoin starts to recover. We're just below 30,000 now, but we've crossed that threshold again, which is nice to see. And hopefully, as we go into the rest of the year, if we see that trend continue, the public data will start to reflect the interest that we're seeing privately behind the scenes. And the other thing that I think is interesting is the broader public case around this, which Quynh alluded to, which is this is not sectoral. This is macroeconomic. We're not only seeing these exact trends in the Web3 digital asset ecosystem and in crypto markets. We're seeing it in the entire technology sector and the entire global economy. Right? All of these things are happening in every other sector around the world. And while the media likes to beat up on Web3, and oh, look at this crash, look at that crash. And of course, we've had some very high-profile flameouts that get a lot of media attention. The trends we're seeing here strongly track the trends we're seeing in more traditional technology sectors and others, where all these valuations are being reset. We work in a lot of industries outside of Web3. It's about maybe 30% of what I do is devoted to crypto and Web3, but I have clients throughout a variety of traditional technology sectors, and valuations in those sectors are down 50 to 70%. And deal volume is down there too. So this is not just a crypto and Web3 story in the data. It's really a macro story. And as we see a macroeconomic recovery, hopefully over the next several months, I expect we'll see not only the private trends that we're seeing in crypto start to percolate into the public data, but the broader recovery that we expect in the economy to also impact crypto as well.
Yeah. So Toby, the panel has been extremely gentle with you. And, but let's look forward as well. Time is passing, but I'm going to steal 5 minutes more. Toby, tell us a little bit more about the crystal ball gazing that we all do, and everybody that's an investor or a deal maker in this industry. Looking forward, volume is there, and as Scott has mentioned, a lot of the deals that I'm doing at the moment are not announced because they're down rounds, they're restructuring. One of my clients went into administration last night, which is why I had an early start this morning. And we've had a whole load of shocks as well. You don't send out a press release on a down round. And so, but Toby's figures, they demonstrate the volumes are similar, but valuations are down. But what's going to happen on that front? And also, my long predicted M&A prediction, in keeping with the other sectors of technology going back 20 years to dot-coms and the internet and so on, is in M&A, industries are created, there is hype, there is volatility, there are too many startups, and then there's a Darwinian process that then leads to the emergence of the big tech companies that are the world's biggest companies today. And they emerged, some of those predated internet, but all of them grew because of the internet. And that consolidation has not yet happened, and we've discussed. So, but my prediction, the regulators will catch up at some point. That's very important for M&A, because how on earth can you price things without some sort of certainty? So that's the big uncertainty at the moment, in my view. But onshore, access to capital markets, larger deals, and higher quality. And also, my view is, as has been the case in all the other technology areas that I've worked on for 25 years, and that is there aren't enough world-class managers running businesses, even if, for every 10 startups, there aren't 10 management teams that can create big companies. And it comes down to human beings, not just technology. So those are some of the themes, Toby, looking forward. What do you think for the rest of the year?
So I think for the rest of the year and the rest 3-5 years, right? I think we're going to get the period where crypto and blockchain grows up, right? I think the the last DeFi summer 2 years ago, I found incredibly exciting. We tracked every pair on Uniswap, SushiSwap, various different niche blockchains. And what was great about those tools, those DEXs, was they essentially allowed you to seamlessly peer-to-peer exchange tokens in a great way, and there was a yield, so all the great RVs and the compounds, and the first promise of truly decentralized finance kind of reared its head in 2020, and before that, in 2017, 2018, to Neil's earlier point, the ICO era, a lot of those companies were actually funded in that area, but with the vaporware pitch. Then you got the 2020 era, where there was still, the great thing was the products worked, which was a change from 2017, 2018. The bad thing was there were fundamental flaws, right? Like the AMM of Uniswap v2, basically, if you were providing liquidity, unless it was juiced by an extra token, it effectively, you would always be losing against someone long one of the tokens or whatever. So DeFi has gradually got more sophisticated. It's slightly broken anyway in a higher interest rate environment. Actually, you can get perhaps a better return on some corporate bonds than you can on many of the DeFi tools, right? So there's a lot of the promise of decentralized finance is slightly broken, and what I think will happen is the amazingly smart minds in the crypto space will fix DeFi. The great thing is CeFi as well. The advent of proof of reserves is imperfect, but at least anyway, we will be wrapping up.
Fantastic. So thanks ever so much for your patience. That's been an absolutely fabulous panel. I look forward to not only lunch, but also